Good morning, and I would like to thank CLAL for giving CME Group the opportunity to present at this year's Dairy Forum. What I'd like to talk about today is developing futures contracts for Europe, Italy, or globally. Quickly, CME Group is an umbrella organization that houses 4 designated contract markets. That's the CME, CBOT, NYMEX, and COMEX. We recently launched a European exchange in London at the beginning of May. These 4 exchanges trade over 3 billion contracts annually, futures and options. We have 6 major product classes: agriculture, financial, metals, and energy. And you can access our markets 24 hours a day, either through our trading floor or through our Globex trading platform. I work in the Research and Product Development Department. We have research staff located in Chicago, New York, London, and Singapore. Most of our staff is located in Chicago and New York. Everyone on staff has a field of expertise, be it in metals or energy. Mine is in dairy and weather products. We are designed contracts, and we also maintain contracts. Over time, a futures contract may change, something may happen in the marketplace, and we have to go in and modify the futures contract. We also do regulatory policy analysis, like on the Farm Bill or things like that, and we also do competitive research for internal white papers for our upper management. We also have interaction with various regulatory agencies, such as the CFTC, which oversees the U.S. commodity markets, the European Commission, and FSA. We also have a lot of interaction with trade associations. We have interaction with academia. We also have it with consultants, because these people are the ones that are the experts in their fields. In dairy, we go to dairy trade associations, we go to cooperatives, we deal directly with corporations because they are the experts. What I do is I gather that information and then, with their help, design a futures product. So what determines a successful or unsuccessful futures contract? And how do we go about designing a futures contract to meet the needs of a specific market? What I did was I went back and I reviewed numerous futures market literature, about 20 studies over the past 50 years. I went back and I looked at what is used and needed to develop a successful contract. And I noticed a lot of these reports or studies, they used various tools and analytical tools and tests to look at various attributes of a successful contract. And then what I did was I put these into a uniform category, and within these categories I ranked them from highest to lowest. So remember, we're looking at about 20 studies over 50 years. And this is what I came up with. These are the top 5 factors that determine a successful futures contract: price transparency and volatility. You need a large underlying cash market. You have to have a lack of a suitable cross hedge. You have to have free of government interference or excess regulation. And you have to have a homogeneous product with established grades, standards for quality and quantity. We're going to go into more detail on these a little bit later in my presentation. So what I did was I said, okay, let's backtest these against some of the CME's agricultural commodities and see how these 5 criteria match up. First thing I noticed was that the first 3 criteria are a must for a futures contract. And again, that was price transparency and volatility, a large underlying cash market, as well as a lack of a suitable cross hedge. 2 out of the 3 isn't good enough. You have to have these 3. It's like a stool, a 3-legged stool. If you take one of these legs away, you're not going to have the foundation to have a successful futures contract. And you can't use an attribute of one of these criteria to offset what's lacking in another. So you can't take a large cash market and go on to try to put that on volatility, because if volatility isn't there, just because you have a large cash market doesn't mean that that's going to make that a 3-legged stool and a solid foundation for a futures contract. The first 2 criteria are very important in the market to prevent squeezes and other forms of market manipulation. Because if you don't have those first 2 criteria, then no one's going to feel comfortable using that contract, because they don't feel confident in the price series that's being used to cash settle that contract. And that's very important, because the market has to feel comfortable with how the contract is designed and settled, so that they'll use that product to manage their risk. The other remaining criteria are self-regulating, meaning that if a government says that a product is illegal, you can't design a futures product for that. Or if it doesn't have certain specifications that everybody agrees on, you cannot design a contract based on something that nobody trusts, or that they don't know what they're trading. So like I said, I went back and I back-tested. I looked at our live cattle, lean hogs, and feeder cattle contract. They met all 5 of the criteria. Milk met all 5, but had weakness in number 4. Number 4 was government regulation. Butter and cheese met all 5, but had weakness in number 2. Non-fat dry milk and dry whey failed 3 of the 5, 1, 2, and 4. And I have that in a nice little chart here. When I looked at these contracts, I looked at when these contracts were first listed for trading. So if we let your eye drop down to non-fat dry milk and dry whey, you'll see that I said that they failed these areas. These non-fat dry milk and dry whey, these contracts were launched or listed for trading in 1999. And at that time, there was no price transparency, there was no volatility, because in the US, non-fat dry milk had a government support price of 80 cents. There wasn't a large competitive cash market, because there was no demand for non-fat dry milk or dry whey. So let's fast forward to 2010. How has that situation changed? Export demand for non-fat dry milk. People have figured out new ways to use dry whey in various products. So that has increased volatility, that has increased price transparency, and the market is starting to develop. A larger cash market is starting to develop. All of these criteria are subjective measures, but you can easily transform them into objective measures. You can go out and you can measure volatility. You can go out and measure market size. So you can measure these things, and you can set bare or minimum standards for these contracts to see if they're going to be successful. But again, these minimum standards that you set, you have to look at the product that you're looking at developing a contract for, because you can't take statistics from the oil market or the corn market and apply that to a dairy contract, because those markets are much more mature, they're much larger than a dairy market. So that's why you have to go back and do your analysis. So now let's look at these criteria in greater detail. Price transparency. That includes fundamental market information, supply, demand, local, regional, national, international, market information. That all plays into price transparency. What's being transmitted around the world globally, if you can see those prices, that adds to the development and the potential success of a futures contract. And price transparency usually comes about from a competitive market structure. The more competition there is, the more pricing data is available so that everybody feels comfortable with the futures contract. And again, it reduces the potential for price manipulation. You'll see price manipulation pop up in a number of these criteria. Again, it's very important that price transparency is seen by everyone on a daily basis, minute-by-minute basis. It's very important because if someone feels that they're not getting this price information in a timely fashion, they're not going to use a futures contract because they're going to feel disadvantaged. And if they feel disadvantaged, someone's not going to use a futures contract. Even though it's designed to be the best, it needs price transparency. Let's look at volatility. Volatility is the driving force behind hedging and speculating. You have to have volatility to make a successful futures contract, because with volatility, you have to manage your price risk. So you're going to use a futures contract. And if you're going to use that futures contract, you're going to want speculators in that futures contract. And you're going to say, well, I've always heard speculators are bad in the marketplace. Speculators are not bad in a futures contract. You need speculators in a futures contract, because if you have everybody hedging on one side of a market, who's going to take the other side? Speculators are the ones that tighten the market. When I mean tighten the market, that means a bid-ask spread. What you're willing to buy the contract or what you're willing to sell the contract. A speculator will come in and tighten that price difference until it becomes a penny difference. Instead of being 10 cents, it's now 1 cent. That means that you can put your trade on or you can exit your trade in a quick fashion. They provide liquidity. You can measure volatility using standard deviation, coefficient of variance, or other statistical measures such as histograms. You also need to evaluate the price data that you're looking at. You have to look for trends, long-term trends. You have to look for seasonality and cycles, so that when you go into a market and you say, well, when is dairy production at its highest? When is it at its lowest? And is this a long-term trend? Can I go back 10 years, 15 years, and see that we have a spring flush and we have plenty of milk? Or as we go into the summer months, production starts to drop off. You have to look at the frequency of the volatility. Is it intraday, daily, weekly? This is all important for a futures contract, because that volatility means that there is opportunity for you to manage your business. And you have to look at the magnitude of those price changes. Yes, you can have volatility, but if that volatility is small, there's really no reason to use a futures contract. You have to have those swings so that you can go in and use a futures contract. Large competitive market, cash market. If you have a large underlying cash market, you have a larger market for hedgers and specs, and that equates to larger volume. And you're looking for larger volume in a futures contract. It's very important to have that volume, because that allows you to put on your trade, to put on your hedge, as well as exit your hedge in a timely fashion without, it's called slippage in the industry, where you want to get out versus what someone's willing to let you out of that market. You also have to look at, again, here's squeezes and market distortions. With a large underlying market, that means there's many participants. There's not one, there's not two, that can control the market, that can say, we'll sell you product at a certain price, and that's it. Take it or leave it. With more competitors in the market, prices are discovered quickly and more efficiently, which helps drive the futures market. You also have to look at what's produced versus what's traded, meaning you can have a lot of product produced, you can have a lot of butter or a lot of cheese produced, but is a lot of that traded in the cash market? If it's not, most of that product is spoken for, So you don't really need a futures contract because there's really nothing to trade. You can also, it has to be balanced of what's produced and what's traded. You also have to look at OTC activity, that's over the counter. That's business or transactions that take place off exchange, off a financial market. If there's a lot of business taking place in the OTC market, that means that there's potential that a futures contract could be developed and designed and take that OTC business and brought onto an exchange for a cleared product that has a credit sleeve. You also have to look at the size of the transactions and the trend. Is the market growing? If the market's growing, that's great because that means that a futures contract can be developed and used by market participants. If the cash market is shrinking, there could be structural changes in that market, and it may be moving towards a monopoly. And you don't want a monopoly because that's not for a competitive market. So perfect competition is the ideal solution or situation for a large and competitive cash market. Again, many markets are oligopolies or monopolies. You're not going to develop a futures contract when there's someone who has a monopoly on the market because people are not going to use a futures product based on a monopoly. Again, here's this prevention of squeezes and other market distortions. Competitive markets are needed for a futures product. And it also needs to be balanced between buyers and sellers. You have to have an equal amount on both sides because you need someone willing to sell product and you need someone willing to buy the product. You need to have that. You can't have one seller of let's just say cheese. You have to have multiple sellers of that same cheese because then that gets back to a monopoly situation and they can dictate the market and they could squeeze that contract and no one's going to use that contract because of that roadblock. You can also look at concentration ratios and other measures to see the size of a competitive market. Lack of a suitable cross-hedge. A cross-hedge is when you have a product in the cash market and there is no futures product linked to that product that you're trying to manage your risk. A cross-hedge is something that's correlated to it. It moves in the same manner. That's a cross-hedge. And you can measure if there's something out there that's a cross-hedge by using a correlation and see how those prices move with the product you want to hedge. But you have to be aware that even though you find something to manage that risk, you're going to have basis risk or price risk. And you can have something that's highly correlated, but you're going to have levels of basis risk between your cash market position and your futures position. And that may be a calendar risk, basis risk, or a location risk. So let's take an example of a cross-hedge in a product that you produce daily, monthly, like cheese, and you find a product that's a cross-hedge. Well, that cross-hedge may not trade every month that you're trying to manage your risk for. So that's where you get a calendar risk. So let's say you want to do a May contract, but the cross-hedge you have is only in June or August. So there's your calendar risk that you're going to incur. Liquidity risk versus basis risk. Market participants will always prefer a liquid contract because that means that they can get into a contract, and once their hedge is through, or if they need to manage that hedge by buying and selling on a monthly basis, they can get out of that contract quickly. And they'll take more basis risk for that versus an illiquid contract, meaning that they can't get out of that contract when they need to exit their risk or their position. Free of government interference or excess regulation. Subsidies, floors, price ceilings, or actual price levels, very damaging to the development of a futures contract because it takes away volatility. Inspections or certificate requirements. I call this the red tape syndrome. You can go through various levels of paperwork to get a plant inspected or products inspected or certified. Trade barriers, again, very damaging. You can have subsidies, you can have indirect taxes, you can have tariffs. Damaging for a futures contract because it's not a free and competitive marketplace. Environmental restrictions. If you want to build a new plant, you want to expand your dairy, you have to meet various regulations. So governments can be unpredictable and destructive, even though they want to be helpful. Homogeneous product with established grade standards and quality and quantity. Very important, because you can have fragmented markets with different types and grades of cheeses or butter. And if you don't have something that's standardized, you won't get the critical mass and the size and liquidity to develop a futures contract that will be successful. With that said, sometimes you can overcome the fragmentation with premiums or discounts. But then that becomes very tedious, because how are you going to change those premiums or discounts? Who's going to decide what those discounts or premiums are going to be? Then I would have to go in and change that contract. Are we going to change those premiums and discounts semi-annually, annually, quarterly? It gets to become very high maintenance. And finally, commodities that do not have formal standards that are enforced by a third party, a contract will not be successful because there's no formal standards. People have to know what they're trading, what the base product that they're trading. It can be a base product and you can be producing something else, but you can always manage your risk with that standard commodity and know the price difference over that standard commodity. And if you have any further questions
Yes.
or comments,